Buy what you know is what Peter taught us.
Buy what you know. This phrase is synonymous with legendary investor and former hedge fund manager Peter Lynch. It is an age-old advice that he continues to repeat to this day. But what does it really mean? Well, for starters, it means understanding that behind every stock is a business, and that when you buy stocks, you are buying a piece of that business. Furthermore, businesses exist within industries, and an understanding of the industry and how your company of choice fits into that industry matters a lot. Now, with that being said, Peter Lynch categorizes all businesses into 6 main categories to help identify the kind of business you're investing in. This is something that he talks about in his book titled One Up on Wall Street, which is such a wonderful book on investing. I highly recommend reading it. So, what are these 6 categories, you may ask? Before I tell you what they are, let me start by explaining that they are all based on company growth, or earnings growth as some may prefer to call it. This is a very important metric for any company as it signifies the direction in which the company is going. Now that we have that out of the way, let's get into these 6 types of businesses, starting with the slow growers. These are companies that have enjoyed a time of rapid growth but have since slowed down. This could be due to the fact that they have reached market saturation or they got too tired to keep chopping and changing in order to stay relevant. Some get to this point due to the industry as a whole slowing down, thus affecting them too. As Peter Lynch puts it, sooner or later, every popular fast-growing industry becomes a slow-growing industry, and numerous analysts and prognosticators are fooled. There's always a tendency to think that things will never change, but inevitably, they do. It's easy enough to spot a slow grower in the books of stock charts. The chart of a slow grower resembles a topographical map of Delaware, which, as you probably know, has no hills. These companies usually grow about 2 to 4% annually in earnings, which is why Peter Lynch likes to refer to them as sluggards. Another common sign of a slow-growing business is the payment of frequent and generous dividends. Companies pay generous dividends when they can dream up new ways to use the money to expand the business. Corporate managers would much prefer to expand the business, an effort that always enhances their prestige, rather than pay a dividend, an effort that is mechanical and requires no imagination. This doesn't mean that by paying a dividend, the corporate directors are doing the wrong thing. In many cases, it may be the best use to which the company's earnings can be put. A big reason why most people invest in such businesses is the dividend. So if you're going to invest into such a business, you must know what to expect. An interesting thing that Peter Lynch does in this book is to give a timeline of different companies and industries and how they went through the period of rapid growth, then eventually slowed down to a point of fitting into this category. Now there's one very interesting line in there. Mind you, this book is from 1992, and this is the prediction that he made. Now even computers are slowing down, at least in the mainframe and mini-computer part of the business. IBM and digital may be slow growers of tomorrow. This prediction was spot on, because if you look at IBM stock now, you'll see that it's been mostly sideways for quite a while. And digital, on the other hand, was acquired by Compaq in 1998, which in turn was acquired by HP in 2001. So if you ever wondered how good of a stock picker Peter Lynch actually is, this, along with his track record, should be more than enough evidence. Now let's move on to the next category, the Stalwarts. These are companies that are faster growers than the slow growers, but aren't exactly the best of the best, or as Peter Lynch puts it, they are good performers, but not the star performers. These usually yield about 10 to 12% annual growth in earnings. These are pretty much the stable companies that one can always rely on. They usually do well, even in times of recession and tough economic conditions, because they have a competitive advantage which makes them relevant all the time. They might maybe go sideways for a bit, but they usually find a way to bounce back. In the book, Peter Lynch gives an example of this kind of company using Kellogg. It's no accident that Kellogg can survive recessions, he says. No matter how bad things get, people still eat cornflakes. They may take fewer trips, postpone the purchase of new cars, buy fewer clothes and expensive knickknacks, and order fewer lobster dinners at restaurants, but they eat just as many cornflakes as ever. Maybe they eat more cornflakes to make up for the lack of lobsters. When it comes to these companies, if you buy them at the right time, you might even see a good amount of growth. Peter Lynch's strategy with these is to hold on to them until they make about a 30 to 50% gain, after which he sells the stock and repeats the process with a similar company. This is something that would require a bit more research and insight, which is what the buy what you know approach is all about. At the end of the day, these are companies that have withstood the test of time and are still making decent returns. They are very nice to have in one's portfolio as they can bring a lot of stability. I can't really say the same about the next category though, the fast growers. These have the potential to get up to 20 to 25% in annual earnings growth. They can be companies that disrupt the market and enjoy a great deal of growth, even in an industry that is showing much growth. Some examples that Peter Lynch gives here include Taco Bell in the fast food business, Walmart in the general store business, and The Gap in the retail clothing business. These upstart enterprises learn to succeed in one place and then to duplicate the winning formula over and over, mall by mall, city by city. The expansion into new markets results in the phenomenal acceleration in earnings that drives the stock price to giddy heights. There's a good amount of risk involved in buying into such companies, so one needs to understand what they're getting themselves into. If not, there's the risk of buying into a company that cannot sustain its growth and ends up going under. In the case of a big company becoming a first mover, as we have witnessed with the likes of Nvidia, they end up becoming overpriced, which eventually makes them less attractive because they end up surrounded by a lot of uncertainty. These businesses, however, are always nice to have depending on what you're trying to achieve. For as long as they can keep it up, fast growers are the big winners in the stock market, says Peter Lynch. When it comes to this category, he looks for companies with a good balance sheet that are also making substantial profits. The trick, he says, is figuring out when they'll stop growing and how much to pay for the growth. So with these companies, you can expect big returns if you get it right, or big losses if you don't. Now here's another interesting category, the cyclicals. These companies, as the name suggests, are those whose business growth is not constant, but rather seasonal. The biggest reason for this, in most cases, is the economic cycle, because most of these businesses sell discretionary goods and services and not consumer staples. In times of economic booms, these companies do very well since consumers have the money to spend. But as soon as there's an economic downturn, consumers start to clamp down on spending, which means that less money flows through to these companies. Peter Lynch had this to say about the cyclicals. Coming out of a recession and into a vigorous economy, the cyclicals flourish and their stock prices tend to rise much faster than the prices of the Stalwarts. This is understandable since people buy new cars and take more airplane trips in a vigorous economy, and there's greater demand for steel, chemicals, etc. But going the other direction, the cyclicals suffer, and so do the pocketbooks of the shareholders. You can lose more than 50% of your investment very quickly if you buy cyclicals in the wrong part of the cycle, and it may be years before you'll see another upswing. If a stalwart can lose half its value in a sorry market and or a national economic slump, a cyclical can lose 80%. If you go back and look at the effects of the dot-com bubble in 2001, the Great Recession in 2008, and the economic downturn of 2020 due to the COVID pandemic on share prices of multiple companies, you'll begin to notice a pattern on certain companies, especially the ones selling discretionary goods and services. That pattern is an indication of the cycle that these companies go through. Here's another important snippet from Peter Lynch. Timing is everything in cyclicals, and you have to be able to detect the early signs that business is falling off or picking up. If you work in some profession that's connected to steel, aluminium, airlines, automobiles, etc., then you've got your edge, and nowhere is it more important than in this kind of investment. If you like observing patterns and trends, or maybe have a certain exposure to the industry that you can use to your advantage, then this might be your kind of investment. Next on the list, we have turnarounds. These companies, as Peter Lynch suggests, aren't slow growers. They are no growers. at least for a little while until the company figures itself out and starts working on something that eventually gets them out of the situation. According to Peter Lynch, there are several kinds of turnarounds. These include number 1, bail us out or else, which is dependent on a government loan being secured in order to stay afloat. Number 2, who would have thunk it, where a company makes a huge loss, almost going bankrupt, then managing to turn things around and grow even bigger. 3, perfectly good companies inside a bankrupt company, where the company just needs to get spun off into its own thing for it to grow properly without being affected by the performance of all the other companies in the group. 4, restructuring to maximize shareholder values. This is where unprofitable subsidiaries are gotten rid of in order to focus on the profitable ones. The best thing about investing in successful turnarounds, Peter Lynch says, is that all of the categories of stocks, their ups and downs, are least related to the general market. You will, as with all the other types, need to understand the company you're investing in and what makes it a good candidate for being a successful turnaround. This gets us to last but definitely not the least of all the categories, which is the asset plays. These are simply companies that have some underlying value that others tend to overlook, especially Wall Street. This could be assets like real estate or cash. For the most part, these are invisible to most people due to the fact that people often just look at the share price and not much more. You would need to understand valuation in order to get the values of these underlying assets right. A lot of these assets become more visible when there's a sale, and only then do people start doing the math. Now here's a shocking quote from Peter Lynch in the book. There are asset plays in metals and in oil, in newspapers and in TV stations, in patented drugs, and even sometimes in company losses. That's what happened with Penn Central. After it came out of bankruptcy, Penn Central had a huge tax loss carry forward, which meant that when it started making money again, it wouldn't have to pay taxes. In those years, the corporate tax rate was 50%, so Penn Central was reborn with a 50% advantage upfront. Actually, Penn Central might have been the ultimate asset play. The company had everything: tax loss carry forward, cash, extensive land holdings in Florida, other land elsewhere, coal in West Virginia, and air rights in Manhattan. Anybody who had anything to do with Penn Central could have figured out that this was a stock worth buying. It went up 8-fold. Of all the categories I've talked about, this one is probably the most technical of them all. But having a knack for tax rules, valuations, and other technicalities can be quite advantageous. If you haven't already noticed, in order for you to make the most of any of the businesses through an investment, you need an understanding of the company. Where in all of these categories does it fall? What advantages does it have? And how can all that favor you? All this can be summarized in Peter Lynch's favorite phrase: buy what you know. Buying what you know means that you will do your own due diligence and won't just go off of what other people say or think. This requires you to work at it. Not only that, but to learn to use your field of expertise to your advantage. So these are the 6 types or categories to invest in as described by Peter Lynch. Again, I'd like to invite you to read his book, One Up on Wall Street, if you are looking to improve as an investor and learn a few stock picking methods that you can use on your investment journey. If you enjoyed this video and would like to see more, then hit the like button for the algorithm and to show support. Then make sure to subscribe to the channel if you haven't already done so. Don't forget to ring the notification bell so you can stay up to date with the channel and make the most of the content posted here in order to make compound interest your best interest. Thanks for watching. If you enjoyed learning from Peter Lynch, then watch this video to learn even more from him. Hope to see you there, but until then, stay invested.